Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this episode of the i3 podcast, I'm speaking with Mary Power, who is the head of property research at asset consultant Jana. We cover the struggles of the property market in the early 90s, when Mary started out in the industry, and the learnings from that time. We take a look at how investors have dealt with 13 consecutive rate rises starting in 2022. And we cover portfolio construction issues, including blending listed and unlisted property assets, the convergence of real estate and infrastructure, while Mary also predicts that up to 50% of Australian property money might be reallocated to international assets as super funds grow bigger. Let's get started. Mary, welcome to the podcast.
Thank you very much. Pleasure to be here.
So you've been with Jana for more than 15 years. What got you into property investing or property research in the first place?
Oh, I might have to let you in on a little secret. I've actually had two stints at Jana. I was actually at Jana in the between 94 and 2000 as well. So yes, I was. How did I get into property? It's a great question. I had a friend whose father was a valuer. And I commenced the property valuations course at RMIT, and he got me a cadetship at Urbis, known as AT Cox then, and I was hooked. Enjoyed it immensely and loved the idea of the commerce and the built form coming together. Yeah, so I really enjoyed it. And I joined at a time when the property market was exuberant in the late 80s, and then it went into the early 90s, which was the recession we had to have. So I saw the best and the worst at the time. And I always say I learned all my skills over those 8 or 9 years.
Yeah, and apart from the environment at the time, has the investment side changed much? I mean, do the valuation practices change? Do the deals change, the structures? What was that like?
It's a great question. In fact, a lot of it's changed and a lot of the fundamentals remain the same. So lots of change, so if you went into the early 90s and we had that recession, which absolutely impacted the office sector, in Melbourne alone, there were 6 office buildings that were built, and they would have been built on not with pre-commitments that you would have today. So they were built by developers who then had to entice tenants in. So we say 1 million square meters of office was built, and then the rest became vacant. So vacancy rose to about 25%, and in fact rents halved. So it was a really dramatic period in the office market, and it was, as a very young person learning, it was fascinating what had happened over that period. We didn't have a funds management basis then. I think as we headed into the 90s, I think AMP and National Mutual were about the only funds managers that were available. Most of property was held within a balanced fund. And of course, over the course of the next few years, if you fast forward to 2025, the Mercer survey is in fact about 94 billion. That's without Goodman. I think that adds another 18 billion on. So, you're a very substantially funds management platform has emerged over that period, over that last 30 years. And, it now consists of specialist sector managers plus diversified managers. So it's been amazing.
Yeah. Sounds like the office sector has gone through a few problematic periods and more exuberant ones, because we've seen, of course, with COVID and as well that it got strongly impacted. We were working from home. Did that experience earlier on help you going through the COVID period?
Hmm. Um, well, I think COVID, I always say COVID was a black swan event. No one had predicted it, but the balance sheets and corporates and employment data was all in good shape. It wasn't the same in the early 90s. We had very high unemployment, up to 11%. Most people I knew had lost their jobs. And these were very smart people. And we had a lot of corporate issues going on in the early 90s. That wasn't the case in COVID. We were in pretty good shape going into COVID. So I think whilst it was annoying and we hadn't seen it before, it was nothing like what I'd seen in the early 90s. So that gave me some comfort at the time.
Yeah.
And of course, we had, the new phenomena of working from home, which was something we hadn't had before. And of course, various states had different lockdown periods. Melbourne had a very severe lockdown period. And of course, it's taken some time for people to return to the office. Yeah.
Yeah, fair enough. So if we fast forward to today's environment, I looked recently in sort of the superannuation returns for the full financial year and split out by the different asset classes. And what sort of struck me is that unlisted has been relatively a poor performer in recent years, last 2 years negative, this year low single digit. But at the other side, first time at single digits again or positive results. Have we turned a corner there?
I think we have. And I think, what happened in 2020 was COVID occurred and there was this, significant lockdown over quite a long period of time. Never good for the built form that have leases in place. They have contractual leases in place, but you still need people to buy things at shopping centres and office buildings to be occupied for those leases to be sustainable and of benefit to the tenant. So I think that was very difficult period. I mean, I would call the property council at the time. They had to negotiate with tenants, thousands of, and come up with a code of conduct of how to interact with a tenant during this, significant period of disruption. And to their credit, they did do that within a reasonably short period of time. On the other hand, an infrastructure asset had one contract. We're talking about thousands of contracts through the property sector. So it was a very difficult period, but I think they did a great job. And then, of course, we headed into, in June 22, the start of 13 interest rate rises,
Yep.
which, of course, was a significant headwind to the property sector because it had performed quite well even through COVID up until the mid 2022. And then we started facing into higher interest rates. And the higher interest rates, in fact, had been quite difficult for cap rates
Yep.
at the time as a differential. So we know what happened. Cap rates expanded, capital values went down. In most cases, the income line, the leasing line, was not too bad. That sort of stood up. It was really the rapid interest rate rises, 13 interest rate rises in a short period of time that really was the problem for the property industry.
Yeah. And then if you look at the listed side of the property sector, somehow they did much better. So I looked at Australian listed property that increased by 13.8%. And then I think international listed property went more than 9%. Why is there such a strong difference between the listed space and the unlisted space over that period?
So I think, the listed is highly correlated to equities. So you have a big influence. I go back to March 2020 and the REIT sector fell by 46%. So that was a very stark fall compared to what the unlisted property index was doing at the time. So the REITs are, they've got some interesting characteristics. For instance, the Goodman Group makes up about 39-40% of the REIT index. So that will rise and fall depending on how Goodman have performed over a period of time. So I think the other thing is that, the REIT sector, while it is very much correlated to equities, it's very interest rate sensitive. So you get interest rate cuts like we've had, very attractive for the REIT sectors. good for repricing of debt, good lead indicator. And I think, the REITs can be a good lead indicator for unlisted property.
Yeah. So do you subscribe to the idea that REITs are equities in the short term and property in the long term, or are they just always equities?
Yeah, I think that's a great question. I think over the long term, you'd think that they do. You do have quite a strong correlation, to property over the long term. I think, though, you need to be able to withstand having them in the portfolio. You do need to be able to be aware of the volatility. So if you're sitting there in March 2020, you have to ask a trustee or a fund how comfortable you are with a 46% drop in your REIT portfolio over that period. Because I think the way we structure a diversified portfolio is we try to buffer, or we try to include asset classes like property and infrastructure and private equity that actually buffer equity market risk. So it actually allows you to have strong equity market exposure, but realise that in a downturn in equity markets that you've got these other unlisted assets that actually provide a buffer and should not decline as far as your equities do.
Yeah. So we've just seen a quite controversial cut in interest rates from the RBA. And then I think there was a lot of comments that they didn't cut the time before that. But now we just seen that inflation figures came out and they are sort of, now I don't know if spiked is the right word, but it went from 1.8 to I think 2.9. What are your thoughts around that? Is that an indication that won't be cut for a while, and how does that affect the property sector?
Yes, always cautious on commenting on interest rate cuts. But look, I'd like to think that there, are some more coming. I think the benefit of the cash rate being cut is obviously in the debt markets. So very attractive for pricing of debt. So that's a big positive. Property people don't generally price off the cash rate. They obviously price off the 10-year bond rate. So the 10-year bond rate at 4.29, 4.3 has been reasonably sticky above that 4% mark. There was some excitement when it got under 4, more than 12 months ago now, 18 months. But I think, to get true increases, it would be great for that 10-year bond rate to come down. The only other benefit, of course, is the cash rate with gearing and debt allows you to be accretive, especially when the markets have bottomed. So, that is an attractive feature if you add gearing onto your base return.
So we've seen a lot of volatility in recent years, and I think you've spoken in the past about the importance of sale evidence stabilizing to get a better sense of where the sector is. Is that happening? Are we getting to a more stable environment?
The short answer is yes. The MSCI Mercer unlisted survey for property is indicating that this is the third quarter of positive returns. So that's fantastic. So yes, we are. I think there's pockets, there's sub-markets now. It's not everything. Not everything is on the rise. And I think our one call out at this moment would be the Melbourne office market at this stage. Again, back to COVID, longer to come out. Had severe lockdowns, longer time returning to work, and there has been some punitive taxes that have been introduced into Victoria around the foreign owners surcharge. And that has deterred offshore investors from coming into Victoria. So we've seen a lot less sales in Victoria than anywhere else. So the sales evidence allows the valuers to actually have some sort of basis for undertaking the evaluations. Melbourne is still a little bit difficult.
Yeah. So those numbers that we mentioned earlier about listed and unlisted, should we take them with a grain of salt then in the unlisted space? Or have there been enough transactions that we can get a good sense of what happened there?
I think we're in a reasonable place with where we're at with valuations now and going forward. And the real green shoots for property are the fact that there's a lack of supply. So what kills property? Supply in a recession like the early 90s. Now hopefully we're not going to have a recession. And supply is very muted.
Yeah.
So that's really positive. And so is the sustainability that tenants are requiring. That's very important. So not every building is the same. So the universe of, you know, desirable buildings has actually shrunk on the basis of sustainability. And that, again, you want to be in those buildings, that's a good thing.
Yeah. So you mentioned that the Melbourne office market, and it seems that there's more and more companies that sort of either reversing the working from home or reducing the number of days that you can do that. Is that supporting the office market? Are we seeing some more positive numbers coming out there?
Yes, I believe so. Yes. And I think, you know, again, with this lack of supply, people are actually got their forward projections a bit wrong. You know, I was over in the UK, there was a big investment house over there that had been in Canary Wharf was coming back to London, and they miscalculated by some enormous amount of seating, whether it was 3,000 seats or something. And instead of being able to go into one location back in the city, they actually had to spread it out across a number. So people aren't necessarily getting the forward-looking labour, employment, seating arrangements right. So it's putting more pressure on certain buildings within certain sub-locations.
Yeah.
So that's a positive thing because it'll drive rents. It will
Yeah.
drive rents, and that will drive returns.
Yeah. Yeah. Yeah, that's interesting. So we talked a little bit about, you know, the unlisted and the listed space, but some of the recent developments we've seen as well that fund has started sort of blending both listed and unlisted exposures, and partly that seems to be, you know, where they have the relationship and the expertise, they tend to go direct, but then in other markets where they might be less familiar with or don't have the relationships, they might have more listed holdings. What is your opinion on that sort of blended approach, and how do you implement it well?
Well, it often circles around two things. One, liquidity. They need some level of liquidity. And the second is that there has been a push over a few years now for where funds have had an unlisted exposure that may have some gaps in it. And they call it a completion portfolio. They may complete the overall exposure on the exposure side with supplementing with some listed. So let's say they're underweight industrial. They may have gone across the globe and bought industrial stocks and used that as their proxy to build up that exposure. I think that can work. It depends on your time frame.
Yep.
And back to your earlier question about, you know, is property is listed REITs more like property on a longer term basis? Yes, I think the answer is yes. And I think but then you've got to marry that up with a fund's ability to absorb the risk of volatility in, you know, periods of stress like we saw in COVID. So it really comes down to the perception of risk and return and that level of tolerance to volatility.
What does it mean for the liquidity profile? Is that harder to manage because obviously listed space is much more liquid? How do you manage that?
Well, that is a very topical question at the moment because there are, you know, funds that are looking to change their liquidity mechanisms rather than one long cliff event. They're looking for quarterly liquidity or allowing investors potentially quarterly liquidity with a cap, not just, you know, they can get out at any stage. I think it's very hard to promise liquidity ongoing quarterly with large assets in a portfolio because I don't know practically how that works. I think people that need liquidity should almost be sticking with REITs.
Yeah.
The only other areas that I've seen is where they've actually buttressed some debt exposure alongside the unlisted that allows some runoff characteristics as loans are realised, and that will give some level of liquidity going forward.
Another development that we've been looking at is there starting to become an overlap between infrastructure and real estate assets? And for examples, we've seen situations where there's empty land at airports or at ports, and perhaps that can be developed for property purposes. What do you see there?
Yeah, definitely. I think going forward there will be a blurring between property and infrastructure, and I think it will be possibly sort of viewed through the lens of the cash flow, because I think one of the things that even this last period of the last 5 years has demonstrated is that, the cash flow needs to be able to withstand things like capital expenditure, and that's a dent to the cash flow. So if you look at infrastructure, mainly it's contracts and they're pretty stable, and you can actually increase the gearing quite substantially. Property, you need to be able to allow for these capex requirements, whether it's incentives or actual expenditure on the building. So I think where you start to get some purity in the cash flow, like you do almost with infrastructure, that'll be a very interesting area of interest.
In the past, infrastructure property either sat in separate asset classes or were an alternative asset class. But we see these days more the rise of sort of mid-risk and these assets being labeled as mid-risk. Is that sort of an indication of that trend that they coming closer together?
Yeah, I think that's really important, because I think what's happening is that illiquid assets now, particularly in property infrastructure, almost need to compete for a place in the portfolio on a whole of portfolio perspective. So if you've got an infrastructure investment and a property investment, you need to look at those on a risk and return basis. So, I think that blurring and that competition between the two asset classes will continue going forward.
Might it also be heightened the competition for these assets by if we get to a stage where there's more and more people retiring, looking for income streams, portfolios probably being more geared toward income streams. Do you think that will contribute to the competition for assets?
Yes, definitely. Definitely. And that stability of income.
So maybe we don't need annuity products, but just more property.
Yeah, and some of the annuity providers had the basis of the annuity has been property assets.
Yeah.
Or a part of it anyway. So yes, I think that's quite possible.
Yeah, very true. So if we look at the environment again today, what are you finding? Where do you find the more interesting opportunities? What sectors look attractive at the moment?
So yes, we have been looking across the globe at all various sectors, and I was going to say 18 months ago we went to Europe. We were very excited in Europe in mid 23. Australia had fallen by minus 1.6. The UK was down minus 17 and the US was down minus 10. So we thought this looks very interesting in the UK. The UK is not always interesting, but it was certainly interesting at that time.
Yeah.
And we identified an opportunity. It was an opportunistic opportunity where we invested, where our clients invested on a multitude of different sectors. But the attractive feature was the discount and the ability for interest rates to fall over time, which was pretty compelling on both fronts, and it's going to be a great vintage for investment over that period.
Yeah.
Closer to home, we've looked at and funds have invested in convenience retail, which is a smaller retail, and the attraction of that is its necessity. You've got to buy there. You need to get your usual everyday goods there, as opposed to experience-based retail. And I think that's going to be a very solid performer, particularly in a falling interest rate environment. So that's been very attractive. We also like the idea of the being smaller assets. More assets, smaller assets. Big assets can have big problems from time to time. So smaller assets can be quite attractive, and we found that to be quite a good way, area to be looking in.
Yeah. Last year, there seemed to be a lot of, I call it hype around sort of the build to rent in the US. But in Australia, it seems to be still a relatively immature market. Is that starting to change, or are we still at the beginning of that?
Look, I think we're still at the beginning. I mean, I was at ANRAV and spoke at on a panel about last week, and I sort of had to remind myself and sort of others that, we've had sort of 5 years taken out of the investment timeline over the last 5 years. So I think we've got to remember where we've been to think about where we're going. And I think, the US has got a 30 or more than probably 40-year history in multifamily. The UK is probably 10, 15 years into it, and Australia's very immature at this stage. And I think there's a few reasons. I think we've had this period of disruption of 5 years or more. we've had, such negative returns that people aren't allocating. And I think that building costs have escalated so much as well.
Yeah.
And development sites have gone down as well in price. So I think, there's a whole lot of things. But I would think if you look forward over years, it will start to mature. I mean, it has to mature. The Housing Australia Future Fund is very prominent. We've looked at HAF deals, which are an interesting structure. They're a debt structure, so a blurring of two asset classes, property and debt. So I think that over time it will mature. And there's certainly a big government push for it to mature.
Yeah. So we talked about a number of opportunities in the different sectors. And I think if you look at property versus sort of other asset classes like equity or bonds, it tends to be a little bit more transactional focused. How do you look at opportunities in terms of a portfolio and the construction of the portfolio? Do you just have to wait for certain deals to come up, or do you really think, okay, we can't, this might be an interesting deal, but from a portfolio perspective, it doesn't make sense to add this at this stage? How do you deal with sort of those tensions?
Well, usually the first question that's asked is what's the deployment capability over 5 years? So if you've got a lot of deployment capacity, that's a great thing because you can actually plot out where you want to be over time. If you haven't got any deployment capability, you're actually waiting on redemptions to come back. That's a much harder game because you've got to wait, you've got to make sure the timing's right. There's not a defined date that you're going to get your money back. So matching deals and flows is very difficult. So if you've got big deployment capabilities, I think we've been very keen to be students of the REIT markets and the debt markets to look where things are moving to. And in fact, we've done a lot of work in the US where we've gone into single family housing, medical office, senior housing, storage. So we've gone into a lot of areas where the REITs were lead indicators for those sectors. So the emergence of the alternate sectors, which is what they're called really, has been expressed through the REITs, which has been interesting.
And how do you look at the tension between sort of large funds and smaller funds in terms of this portfolio construction question? Because sometimes it seems that smaller funds have less ability to take on a lot of illiquidity. Is that true, or how do you look at that question?
Well, I think you've really got to start. I like to start at the basics. What's the investment objective for the fund? What's their tolerance for volatility? And then how much equities and bonds do they have in the portfolio? And then how much illiquid assets do they have? If they're running an illiquid exposure of 40%, that's very high. And that could be across property, infrastructure, private credit and private equity. So you need to sort of start with the basics of each fund and how the composition is at the time. Look at their investment objective. If they've got a CPI plus 2, it's very different to a CPI plus 7.
Yeah.
Expectation. So you need to be able to construct your portfolio based on what their expectations are for risk and return.
And another trend we've seen recently is there's a lot of talk about total portfolio approach or the joint up investing. And in sort of the conversations I had around that is one sort of hurdle that they need to overcome is to speak the same language around investments. And that can be quite different whether you talk about property or you talk about equities or fixed income. How do you see that conversation taking place with sort of Jana's clients? Is it hard to make the translation exercise?
I don't think we've had a problem with that. I mean, we look at discount rates across infrastructure and property, forward-looking PEs in private equity. So I don't think that we've had much of a problem with the language going forward. So I think we understand, discount rates, cap rates, growth rates. I mean, discount rates, CAGRs, leverage, all really important parts of the investment subset across every asset class, really.
Yeah, for sure. If we sort of look a little bit ahead, how do you think that the blend between sort of super funds exposure to Australian property and international property will develop over time? Are we seeing less investment in Australian and more in international, like we see probably more money shifting into international equities, or what is sort of your view there?
Well, I think it is inevitable money will go offshore, and it has. The big funds with lots of deployment capacity are likely to take up exposures in areas that they can't get here domestically. So that's some of the areas that I spoke about earlier: single family housing, medical office. So those that have developed up and have some level of track record, investment, the markets are quite deep. So I think money will definitely go offshore. What percentage of a total property allocation would go offshore? I'd say up to 50% could.
Okay.
It could be anywhere between 30 and 50.
Yeah.
Um,
And do you expect to see a shift as well in the mix between unlisted and listed? Or is that more up to the individual fund?
It's very much an individual fund basis, very much an individual fund. Again, perhaps if there's a reason they need liquidity for within the portfolio, they might elect to have an allocation to REITs.
Yeah, for sure. Well, Mary, thank you very much for participating in this podcast. It was great to have you on the show.
Oh, thank you very much for having me. Thank you.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3, -invest.com. And don't forget to like, subscribe and review. Thank you very much.